December 9th, 2025, 2 p.m. EST. Jerome Powell steps to the podium and announces a 0.25% rate cut, the third consecutive reduction since September. Within 67 minutes, silver explodes past $67 per ounce for the first time in human history. Not gradually, not over days or weeks. In 1 hour and 7 minutes, 45 years of price suppression shattered like glass. I've been tracking this pattern for months, and what happened on December 9th wasn't random market volatility. This was the completion of a four-stage mechanism that's played out across every monetary crisis in recorded history. The same pattern that destroyed the Roman denarius when emperors debased silver content from 98% to 5% over 2 centuries. The same sequence that obliterated the Weimar Republic when printing presses replaced fiscal discipline. The identical framework that Nixon triggered in 1971 when he closed the gold window and silver went from $1.39 to $49.45 over the next 9 years. But here's what caught my attention that afternoon. While silver was detonating through every resistance level, JP Morgan's COMEX vaults reported a technical glitch in their delivery system. For 43 minutes, no registered silver was available for immediate delivery. 43 minutes. In a market where contracts expire in real time and industrial buyers need physical metal to keep factories running. That wasn't a glitch. That was panic. 3 hours before Powell's announcement, I noticed something that made my blood run cold. The silver lease rates spiked to 47% annualized. Think about that number. Banks were charging 47% interest just to borrow silver for 30 days. When money costs nothing and silver costs everything, you're not looking at a commodity trade. You're witnessing the breakdown of a monetary system that's been 54 years in the making. The pattern is always the same. Stage 1. Establish artificial stability through paper promises. Stage 2. Expand the paper system until it dwarfs physical reality. Stage 3. Demand shock when someone calls the bluff. Stage 4. The paper market collapses and only physical matters. Every empire, every currency, every commodity manipulation scheme. The Romans debased their silver coins until merchants refused them. The British suspended gold convertibility in 1931 when France demanded physical delivery. Nixon ended Bretton Woods when European banks wanted gold for their dollars. And on December 9th, 2025, the Federal Reserve triggered Stage 4 for silver. What happened wasn't just about interest rates. Powell's cut was the signal that confirmed what smart money had suspected for months. The dollar is dying. Inflation is accelerating despite official statistics showing otherwise. And the only assets that matter are the ones you can hold in your hands. When central banks admit they're out of tools except printing more money, precious metals become the only rational response. But this time, it wasn't just gold leading the charge. Silver moved first, faster, and more violently than anyone predicted. Here's what nobody saw coming. The December 9th rate cut wasn't just monetary policy. It was the moment when 54 years of financial engineering collided with the laws of physics. You cannot print silver. You cannot create it with algorithms or Federal Reserve balance sheet expansion. You cannot substitute it in solar panels or electric vehicles without massive efficiency losses. When the paper money system admits defeat by cutting rates during persistent inflation, reality reasserts itself with mathematical precision. And silver, being both monetary metal and irreplaceable industrial commodity, became ground zero for the largest wealth transfer in commodity history. The implications extend far beyond precious metals markets. December 9th marked the day when industrial civilization recognized that its most critical materials cannot be financialized, manipulated, or created through monetary policy. Physical reality has mathematical limits that central bank imagination cannot overcome. Let me show you exactly how this pattern works by walking through 3 historical examples. Once you see the mechanism, you can't unsee it, and you'll understand why December 9th was inevitable. Rome, 64 AD to 274 AD. Stage 1. Silver denarii contained 98% pure silver and were accepted across the known world. Stable money for 2 centuries. Stage 2. Emperors started reducing silver content to fund wars and social programs. By 200 AD, coins were only 5% silver. Stage 3. Merchants began refusing debased coins, demanding full-weight silver or gold. Stage 4. The entire monetary system collapsed, trade networks fragmented, and the Western Empire fell within decades. The pattern took 210 years to complete. Britain, 1925 to 1931. Stage 1. The pound sterling was backed by gold at $4.86 per pound. Global confidence, stable prices, London dominated world finance. Stage 2. World War I forced Britain off the gold standard temporarily. They returned in 1925, but at an artificially high rate that made British exports uncompetitive. Stage 3. France accumulated pounds and demanded gold conversion. Other nations followed. Britain's gold reserves drained from 140 million pounds to 35 million in 18 months. Stage 4. September 21, 1931. Britain abandoned gold forever. The pound collapsed 25% overnight. The pattern completed in 6 years. United States, 1971. Nixon shock. Stage 1. Bretton Woods system established the dollar as reserve currency, backed by gold at $35 per ounce. Stable system for 25 years. Stage 2. Vietnam War spending and Great Society programs created massive dollar inflation without corresponding gold backing. Stage 3. France's Charles de Gaulle demanded physical gold for excess dollars. Other nations followed. U.S. gold reserves plummeted from 20,000 tons to 8,000 tons between 1958 and 1971. Stage 4. August 15, 1971. Nixon closed the gold window. Gold went from $35 to $850. Silver exploded from $1.39 to $49.45. The pattern completed in 13 years. Now, silver 2025. Stage 1 established after the Hunt brothers manipulation in 1980. Regulators created a massive paper silver market. COMEX expanded derivatives trading. ETFs were launched allowing silver ownership without physical delivery. For 45 years, paper silver traded smoothly. Prices stayed suppressed. Everyone trusted the system. Stage 2 began after 2008 financial crisis. Central banks printed $30 trillion globally, while silver mine production declined 7% since 2016. Industrial demand from solar panels, electric vehicles, and electronics doubled. Paper markets expanded to 244% of available physical silver. Stage 3 activated in 2024. COMEX registered inventories dropped 60% in 4 years. Industrial users began stockpiling. Physical premiums started rising. Silver lease rates spiked periodically to emergency levels. December 9th was Stage 4. The moment paper silver divorced from physical reality. But here's the part that should terrify every central banker on Earth. This pattern is accelerating. Rome took 210 years. Britain took 6 years. The 1971 dollar collapse took thrice to resolution. The silver system broke in less than 18 months from first warning signs to complete dysfunction. Why the acceleration? Information travels at light speed. Markets are globally connected. Algorithmic trading amplifies moves. And unlike previous monetary crises, this one involves an industrial commodity that cannot be substituted. You could replace gold with other monetary assets during historical crises. You cannot replace silver in solar panels, electronics, or medical equipment without massive cost and efficiency penalties. The data confirms what history predicts. Global silver demand in 2025 reached 1.2 billion ounces. Mine production peaked at 880 million ounces and is declining due to ore grade degradation and underinvestment. The deficit of 320 million ounces per year has been filled by draining above-ground stockpiles accumulated over decades. COMEX registered silver dropped from 400 million ounces in 2020 to 113 million ounces in December 2025. At current consumption rates, registered inventories represent less than 5 weeks of global industrial demand. When Powell cut rates on December 9th, he wasn't just lowering borrowing costs. He was signaling that the Federal Reserve had lost control of inflation and was reverting to the only tool they understand: printing money. Smart money recognized the signal instantly. Physical silver became the only rational hedge against monetary destruction. And unlike gold, silver had the additional catalyst of massive industrial demand that cannot be reduced or delayed. The result was mathematical. Paper silver markets had promises outstanding for 244% of available metal. When even a small percentage of holders demanded physical delivery, the system had no choice but to break. December 9th was the day when reality met promises, and reality won. I keep thinking about those 43 minutes when COMEX delivery systems went offline. In the digital age, when high-frequency algorithms execute millions of trades per second, a 43-minute technical glitch in physical delivery is like a bank running out of cash at the ATM during normal business hours. It doesn't happen by accident. It happens when the vault is empty and someone needs time to figure out what to do next. Here's what nobody understood about December 9th until it was too late. The Fed rate cut wasn't just monetary policy. It was the trigger that activated a mechanism building pressure for 6 years. A mechanism connecting central bank desperation to commodity physics in ways most analysts missed. When central banks cut rates, they admit they cannot control outcomes through normal tools. Lower rates signal currency debasement and monetary stress. Smart money flows toward hard assets. But December 9th was different. Silver moved first, faster than gold. Why? Industrial demand meets monetary demand at the moment physical supply disappears. Solar installations in 2025 consumed 200 million ounces, double 2020 levels. Electric vehicles used 150 million ounces. Total industrial demand hit 750 million ounces, while mine production declined to 630 million. The 120 million ounce deficit came from financial inventories. For 6 years, above-ground silver was consumed faster than new production. Banking masked this through expanded paper markets. Derivatives and ETF shares created abundant silver illusion when physical metal grew scarce. December 9th. Illusion met reality. Here's the hidden mechanism. Fed rate cuts make borrowing cheaper for industrial companies needing silver for production. Cheaper money increases commodity demand. Lower rates make physical assets more attractive than bank interest. Investment demand surges. Rate cuts create double silver demand shock. Industrial buyers securing supply with cheap money, investors fleeing currency debasement. Add time pressure. Solar manufacturers cannot wait months for delivery. Production schedules are locked. When physical silver becomes scarce, industrial buyers pay any price for immediate delivery. They have no choice. This creates backwardation. Immediate delivery costs more than future delivery. On December 9th, spot silver hit $67.20, while March futures traded at $63.40. That $3.80 spread was pure panic premium. The Fed's cut validated dollar stability fears. International buyers converted dollar reserves into physical silver, not ETFs or futures, physical metal in allocated storage outside U.S. banking. Foreign demand pressurized an already stressed market. The mechanism becomes self-reinforcing. Higher prices attract speculation, increasing demand, reducing supply, forcing prices higher. Unlike normal commodities, silver cannot be substituted in industrial applications without massive efficiency losses. When physical silver disappears, production stops. When production stops, panic buying begins. When panic buying meets monetary debasement, prices gap violently, destroying paper markets. December 9th revealed the mechanism completely in 67 minutes. 45 years of paper markets and price suppression collapsed when physical reality reasserted itself. The rate cut was just the trigger. The explosive device was built over decades of manipulation and industrial demand growth. What happens next isn't prediction, it's pattern completion. Silver at $67 is not the destination, it's the departure point. Every historical precedent shows the same sequence: initial break, brief consolidation, then parabolic acceleration. The Hunt brothers reached $49 in 1980 using leverage and failed because they fought the system. December 9th proved the system itself is now silver's ally. Here's what keeps me awake at night. The silver market that broke on December 9th represented less than 5% of global investment capital. When institutional money recognizes that silver offers both monetary protection and supply-demand fundamentals, the buying pressure will dwarf December's explosion. Physical silver available for investment totals 2 billion ounces globally. At $67 per ounce, that's $134 billion total. Apple's cash position alone exceeds that amount. When corporate America realizes that depreciating dollars make less sense than appreciating silver with industrial utility, the scramble will make December 9th look like practice. The mechanism is now visible and accelerating. The Fed admits defeat through rate cuts while claiming victory over inflation. Industrial demand grows exponentially with every solar installation and electric vehicle. Physical inventories decline every quarter while paper promises multiply. But there's something that makes this different from every previous monetary crisis: technology dependence. Modern civilization requires silver for basic infrastructure. When silver becomes scarce, industrial civilization faces a choice: pay any price or watch critical systems fail. Stage 4 has begun, but it's far from complete. The mechanism that broke on December 9th will repeat until either supply increases dramatically or demand destruction occurs through economic collapse. Do you still believe silver at $67 was the peak, or do you see the pattern that suggests we're in the early stages of the largest monetary metal revaluation in 50 years? The mathematics suggest the answer is already written in the empty vaults.